Okay. We are all live.
Hey.
Welcome everyone. Welcome back on the Smart Investing with Clem Chambers and hopefully Zach. But Clem, great to have you on the show today. How are you?
I'm very good. I managed to show up on time for a change. I always get distracted just the last minute. I go, it's 11 o'clock, I've got to be there, got to be there. Oh, it's 10:30. Oh, blah, blah, blah. Oh, yes. Oh, it's 15 minutes to go, blah, 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 blah. Oh, I'm late.
So I see you are excited. So what is making you happy?
Well, I mean, there's a lot going on at the moment, and that's always exciting. The market's enough to make anybody excited, up and down and all over the place. And you know, I've been I'm mostly a market watcher, and I spend a lot of time doing just that. And today I've decided that the banks are starting to look good again. So I bought a clip of Barclays because that's really down. I mean, one of the things that investors should do is follow really good companies, and the ones that have been hammered, watch them be hammered and let them bang, 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 bang. You don't buy them. Bang, 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 down. Oh, look at that. It's getting really cheap now. Don't buy it. Bang, 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 down it goes, down it goes. And then it will stop going down. It'll go sideways. And then you've got a choice to think, well, it's now very cheap and it stopped going down. Now, is it going to suddenly go down, 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 down? Or is now the turning point? And that is quite an interesting game. You won't get it right every time. But and sometimes you think a company's really good and it's rubbish, and you won't get it right every time. But most of the time, you will get in near the bottom. And when it turns, like for example, Barclays might have done today or yesterday, you know, they've got quite a long way to go back. And if you were to have a look at the Barclays chart, I mean, Barclays is a good one for me because I always get Barclays wrong. I always buy at the wrong time in Barclays. It's like a historical thing for me. When I buy Barclays, it's always the wrong time. But I don't stop. I don't let that stop me. So the banks are quite heavily hammered. But as we've got a rising interest rate environment, they're meant to make a lot more money. Now, when they were being pushed down with low interest rates, someone's saying, oh, well, you know, the banks aren't making money because of low interest rates. And then, of course, when interest rates go up, they'll say, oh, well, banks are going down because, you know, people can't afford to pay off their loans. It's going to be bad debts. And you can't really have it both ways. I think that if a good company has been around forever that hasn't got something horrible that's happened to it, goes down for an extended period of time and stops going down, it's likely to turn around and come back. And anybody that watches the market and anybody that looks at charts will see perfectly good companies dropping and then recovering back to their previous high, maybe 5, 6, 10 times over a period of years. And of course, if you can work out when to get in and when to get out in that situation, which is swing trading, there's good money to be made. It's not short-term money because it might take 6 months for it to recover.
So basically, Clem, you're saying at the moment, as the market is still volatile, basically the opportunities, they are trading opportunities.
There's a lot of trading opportunities out there because the market, as far as I can tell, is dysfunctional. Okay. And that is to say that I have no idea what the hell's going on, because one day a stock can be up 5%, and the next day it can be down 5%, which is basically noise. Now, you can't predict noise. You can't explain it away. You can't say when it's going to happen and when it's going to stop happening. That's what noise is. It's a random thing. But the more random the market is, the more opportunities there are to make money from arbitrary moves. Because if it goes down 5% randomly and it goes up 5% randomly, you know, really hasn't moved at all. So every time it goes one way, you go against the noise. You buy the noise and you sell the noise. And that is a good way to make money. And there's a reason why it's a good way to make money, because the market will be paying you to take away the volatility. And the market pays you to do things and punishes you for doing other things. So if you're buying and selling, it will punish you for that. It doesn't need that. It needs people who buy and sell for the benefit of the market as a whole. Okay. So if you're a market maker, for example, you're sat there, you'll sell at this price and you'll buy at that price. And that gives liquidity to the market, and the market pays that market maker that spread to offer that liquidity. So the liquidity providers get paid by the market to offer liquidity. If you're a liquidity taker, you take the liquidity out of the market, i.e. you buy here and you sell there. It takes money off you. And the market will always pay you to give it a service, and will always charge you if you're using the market as a service. So that's the thing to remember. You want to be on the side of having the market pay you for providing it a service. And in this case, if you buy noise when it pushes the price down, and you sell noise when it pushes the price up, it will reward you for that, because the market doesn't want noise, and rewards people for taking the noise out.
Okay, so Clem, just want to remind everybody watching, if you have got a question, you can just drop it in the YouTube channel, and then in the YouTube chat, and we can cover it. So let's talk about this trading opportunity. Until we have a question, then maybe I can start to ask you something. Have you bought some Netflix from the disaster that happened last week?
I admit that I did. And the reason why I did was I do like stocks that implode. If there's not an extremely good reason for it, because when shares like Netflix implode like they do, they overreact quite often. And it's always fun to be the person that buys the bottom and gets a nice little pop. Now, and it's fun. So it really is just like kicking a ball around in the park for me. So I'd never do it, I'd never do it in the scale of millions, but a few tens of thousands. Now that's a bit of fun. And it turns out over time, it's also quite profitable. But what I've been doing recently, and I totally advise against it, is I've been using these sort of situations to experiment with options.
Okay.
Now, options is a real tough game, because you are playing poker with the world champion. Because the people that write options are, mathematical geniuses with computers. That they are, they may never be outnumbered, but they always outgun you. And so I've been experimenting in options for some time, and I like to these days do what they do, which is sell options. Now, when something like a Netflix implodes, the value of premium you can get by selling an option, a put option or a call option, is just massive. It's like 5% for a few days. So while it's an exciting game, maybe a little bit too exciting, there's a lot of juice in that market if you're prepared to sell options, if you're prepared to skill up on option selling.
Okay, Clem, let's stop here. Option, first of all, when you buy an option, you buy what the price is.
Well, I'd be selling them, you see.
Okay.
I would be selling to people who want to buy them. So there's two sides of the equation. If you want to buy an option, a call option on Netflix, you will pay, say, right now, you could pay easily pay $5 to $10 on 200 to be able to buy at a certain price. Yeah, a call option, for example. Now, if you buy the option, you're, in my book, on the wrong end of that trade, because the guys selling the options are the professionals. And they'll say, yeah, you want an option? It's $5, mate. And then you go, oh, yeah, it's going to go to the moon. Yeah, give me that for $5. Funny enough, it doesn't go to the moon, and you lose those $5. So I'm experimenting, researching, playing with, mucking about with writing options, call options and put options. So right now I've got a reasonable chunk of I'm short calls, and I'm also short puts. So I've sold some puts and I've sold some calls, and actually I'm kind of not out of the money from where I bought in. So I've sold sufficient calls to cover the drop, and that in itself is interesting, but it's purely a research project. Because I tell you, if you think that there's smart people trading stocks, you ain't seen nothing until you see options. Those guys are, red, and girls are red hot, and therefore that's a shark tank I'm enjoying swimming in, because that is a very, very strict and clear cut and interesting challenge.
Okay, well, it would be interesting to see what's going to happen to Netflix. I just got a notification saying they're going to increase the price. I think it's £1 or something per month, saying they're going to bring you the best of the entertainment, which is quite exciting. So,
Well, I mean,
yeah.
I don't have Netflix myself. I don't have a television myself. I haven't had television for 30 years. So when people say, "Oh, look, there's somebody famous over there. They were in ABC 27 or whatever," you know, it means nothing to me.
It's
But
nothing.
nothing to me. But interestingly enough, the Nasdaq looks like it's going to keel over and die, and I think that's quite interesting. Because I wrote an article for Seeking Alpha back in October saying this chart's can only do this, and it did. It's doing exactly that right now. And they wrote to me a couple of days ago and they said, would you write an article about Musk and Twitter, please, for us? We'd love you to do that. And by the way, we'll cross your palm with silver if you do it. So I wrote this thing about Musk, and then I thought, well, how much am I making on Seeking Alpha? Oh, there's an article. Well, let me look at that I wrote in October, and there's the blooming Nasdaq chart that today's Nasdaq chart that I wrote in October, which is it's always good to be right. And I thought, well, that if you look at the Nasdaq chart, it's got crash written all over it, absolutely written all over it. So I'm glad I've got sold a few calls. I'm also happy that I've got the underlying, and I might end up with more of it with the puts that I've sold. But it's an interesting dynamic overall, because the Nasdaq, if that goes down, that's going to make a really large smoking crater in the American economy, which might be the reason it will do it. Because if you want to get rid of inflation, the quickest way to do it is to crash the stock market.
Yeah.
Because that will take so much money out of the hands of people that you'll immediately have a liquidity crisis.
Okay.
And inflation goes away.
So if any viewers has got any question about this potential crash, please drop them in the chat. So Clem, let's see the scenario that this crash is really going to happen. What are the signals that the red flags, they will say, okay, right, this is the time? Because I remember you just called the crash for when it was before the COVID. So I mean, I'm sure that you know what the signals are. Maybe this is what people want to know.
Well, we've had them. They've already, yeah. I mean, it's not going to be one of these. You wake up in the morning and it's down 20%. It's already crashing. And if you look at the Nasdaq in particular, a lot of companies are down 50% already, but they're the small ones. So it's the giant Apples of this world, Google, Amazons of this world, that are keeping that index up. Well, that index is off quite a lot now. And if those big ones go, now the red flag that was absolutely glaring was the S&P 500, which was going in a straight diagonal line.
Yeah.
Like straight. And I wrote a long time ago, well, you can sit on that trend. That's fine. The trend is your friend until the bend in the end. So the moment you see that thing go out of the trend, that's the time to be very,
okay.
very
When that happened? When happened? When that?
Oh, have a look. Pull up the chart, Steph. You can share the screen and we have a look. I'll talk you through.
Okay, so let me just get prepared so you can just.
I'll talk amongst myself.
Yeah, exactly.
But if you look at the Nasdaq chart, it's looking like a repeat of the dot-com crash. And of course, the situation is very similar with all these ridiculously high valuations of all sorts of funky stuff.
Okay, so here we are, and Zach is also joining. So let's.
If you go to charts, and I don't go up to charts yet, and type in SPY.
SPY.
Yeah, and then that will do. Yeah.
SPY. Yeah.
Yeah, and now.
Ooh.
So now, if you were to say click on 2020 and drag it out to the left-hand side, down a bit. No.
Okay.
Go down to 2020 where it says 2020.
Yeah.
Right on, down a bit there. Now drag it a bit to the other way. Other way.
The other way. Okay. Let me just. Yeah.
Yeah. There you go. Keep going. Stop. Right.
Yeah.
So now, actually, you need to drag the whole thing a little bit to the left. No, no, that's the right, and that's not the thing you need to drag. Stop there. Yeah, drag that bit to the left. Keep going, keep going. Stop. Stop there. Right.
Okay.
And now move that. Yeah, there you go. Stop there. Right. So you see that straight line.
Yeah.
Now that straight line was caused by the Federal Reserve pumping liquidity into the market, and when they stopped, you get what's happened since January, which is a bear market. Now that is a bear market. Every time it kicks, it goes down. So we're in a bear market. Now, obviously all the Muppets on television go, oh, the market has just fallen 20%. We're now entering a bear market, which is a bit like saying, going into a hospital and seeing someone in a hospital bed and say, oh, look, this person is about to be run over by a car. Yeah. You're in a bear market when the market starts to fall, not after it's fallen.
Yeah.
And being in a bear market enables you to judge the direction of the future, not the direction of the past. And we're in a bear market, it's going down. It might jump up, it might go sideways, but since January 2022, it's been going down. And from the beginning of COVID, after that first bump, it was going in a straight line up.
So Clem, if we go back and we see a similar situation happening in the past, because usually history is our friend, I learn from you, but
well, there you are. You can see that it's been
when we are coming back from, that's quite, I mean, it never stopped to go up.
Well, you know, you've got a few years of sideways in 2015. You've got a nasty break in 2018.
Okay, here it is.
That is the credit crunch.
The credit crunch. Okay, that was COVID.
And they've been, and the one before that was when they did QT, when they stopped doing QE and they stopped pumping money in, you got that drop. And that drop is what we're getting now because they've stopped QE and we're getting that drop kicking in.
So Clem, just to clarify, this one you mean?
No, if you go back to COVID one, if you go to look at the COVID one, put your pointer over COVID.
Yeah.
Up a bit, up.
Yeah, it's this one, the COVID.
Yeah. Now stop. Go back there.
Yeah.
Now, if you go to the left a bit, that downward spike, that's 2018. And that's when the Fed tried to stop QE and pull money out of the system, which is exactly what's happening now. And they had to stop. Not only did they have to stop QT, which is the opposite of QE, they had to start QE again. Because the moment you pull money out of the market, you created a market. And the reason it's so high was they've been pushing money in. Now, you could say, well, they're going to pull money out. And when they pull money out, the market will crash. And that will stop inflation dead in its tracks. And that's what they're going to do because they want to stop inflation dead in its tracks. But I would say, I don't think that's right. Because ultimately, they've been propping up the market with new money for two reasons. Because if you're going to support your economy, you're going to stimulate the economy. There's two groups of people that you want to stimulate. You want to stimulate homeowners and you want to stimulate people with stocks because that supports the whole economy. That supports trickle down. And trickle down means that you don't get inflation. Now, if you take that cash and you stimulate the poor who don't have houses, who do not have equities, they go out and they spend it immediately.
Yeah,
and that pushes prices up. So you get inflation if you stimulate it that way, which is what they did in COVID because they gave everybody checks. In America, today, right now, a lot of people still don't have to pay their rent.
So Clem, considering we are in a bad market and the Nasdaq might crash, what will be your vision, your prediction? It will crash 50%, 20%, 10%?
On that chart, I would say you're looking at 350, 360 on the SP.
All right. Okay. So that which means the stocks can go down how much?
Well, that's basically 60. That's about 50% from here.
50% from here.
15%.
Obviously, 15. Okay. Well, I was thinking about small caps, so they might go down even 70.
Small caps. If you want to see what's going to happen with small caps, just type in there FTSE (SMS), FTSE : colon.
Yeah.
No, don't do that. No. SMX. S for sugar, M for mother, X for extra. And you put a space there. I don't know whether that's going to break it or not. There you go. SMX. There you go. Now, this is a fabulous chart. I use this chart often. It's really, really good. Now, if you go to the bottom and you stretch it so you can see the last 20 years, keep going. Yeah, stretch. Keep going. More. Yeah, more. Hello. Now, you see, that's a brilliant chart, because the small cap index, it is either going up or it's going down. It doesn't mess about. It doesn't have much noise. When it's going to go, well, you can go back that far.
No, I was trying to go back until I was born.
Okay, well, that's 2000, isn't it?
Okay, that's it. No, that's 85. That's my year. Okay, fine. Great. That's interesting.
You see that it's very, very unvolatile. It just goes up. And when it starts to go up, it keeps going up. And when it goes down, it keeps going down.
Yeah.
So it's a very strong trending index, because it's not a victim of all these arbitrages that muck about with the FTSE. So if you put in, which is overlays, if you go up to overlays, and you type in UKX, leave it like that. Right. Yeah. So you'll see, it's not obviously clear here, but you can just about see it, that the FTSE 100 is much more volatile than the small cap. It travels more and tends to be more noisy. And if you say you stretch it out. So
no. So wait a second. So until here we have them similar. Then
very, very similar.
And then here there is a big divide where the small cap go higher.
Outperforms.
But okay, they outperform, and the FTSE just recover more.
So if you go to 1 year rather than 5.
Yeah, that's so very interesting.
So you'll see that the in fact, that's interesting, because in the last year, the small caps have underperformed the big caps. Now, if you were to put bars on there, so if you go up, like, I'll probably best not get too detailed here, but in general, the FTSE is a lot more volatile than the small cap index, because of the way it moves more, because of the way that the FTSE is influenced by futures and options and other arbitrage, currency and commodities. So when you start to look at the SMX, you get a much clearer picture of what's going on. And you can see it's in a bear. So if you put 3 years on there, in fact, what you're probably seeing there, the recent outperform is probably because there's not much minerals, there's not much commodities in the small cap index, where there's a lot in the big cap index. So you can see quite clearly in the small cap index, you're in a bear market, and you've been in one since July. And it either goes up and keeps going up, or it goes down and it keeps going down. And it keeps going down mode. It's in a bear mode. So that is telling you that we're in a bearish situation. Okay. Now, the flip side of that is, I don't believe that any government is going to let its market collapse and take down its economy with it. So they are going to be moderating any fall. So you're going to be seeing swings. You're going to be seeing, volatility, where the central powers are trying to moderate and curate the markets and make them go, not go too far one way or the other. So I think you see that after, say, if the small cap index hit 6,000, or suddenly the FTSE dropped 10%, that was going to be your limit, because every time it looks like it's going to die, they will come and prop it up. And that will mean you'll get these swings, but you will be able to pick up cheap stock at the bottom of the swing and then sell it on the way back up again.
With the trade you just mentioned.
Yeah, it's a trading environment for sure.
So Zach, welcome. Finally, great to have you on the show. Do you wanna comment on this trend and what Clem brought up?
No, I suppose it has been encouraging that the small caps are the growth area, and I think given how the FTSE has been in the same sort of range for the last 20 years, it has been extremely disappointing. I think in the UK market, you've got to get the small cap area right in order to create alpha. The blue chips just seem to be a sort of a dividend exercise, and whether it's at 7,000 or 7,300 or 200, it's the same numbers we've had there for the blue chips on for nearly 25 years. It's also amazing that even though you've got all that commodity boom that we've had in the last in a sort of inflationary commodity boom, the FTSE hasn't really been able to get its act together and finally get through 8,000, which I think would be is the big goal. It's a very difficult one. I think Clem's argument about whether the authorities would at the moment they just keep sort of buying the dips to prevent a crash, but the policy they seem to have is to create a crash. The rising interest rates to chase the inflation rate. It just seems like madness.
Well, I've got a point there that I think people should think about. It's not about the interest rate; it's about the ability to borrow money. So if the liquidity is there, the interest rate.
No, I mean you've said that on, and I've learned that from you. You've said that, and it is obviously clearly a good point. I think that it would be better to, rather than raising rates, make borrowing more and more difficult. So you've got to put in like 80% of the deposit on a house, or 70% or 50% or whatever is puts people off. So I think making borrowing more difficult, which they have done anyway compared to 20 years ago, is the way to do it. I don't think that the way to do it is to raise interest rates to chase the inflation rate. It's a blunt instrument. It makes companies go bust, and a company going bust, and then that might be fine because it's not an efficient company. But you make lots of good companies go bust, and there's a 1 year, 2 year, 3 year lead-in time for a recovery, and that's a mistake. That was a 20th century mistake. And we have.
I have got some question, Zach. I'm going to interrupt you. I've got some question from our viewers. So, first of all, let's just ask about. Let's go back to Barclays, Clem. Is it going to go up? Do you have any kind of
pull up the chart. And
because I'm trying to monitor the question as well, so it's not so easy. But yeah,
if you can pull up the Barclays chart from that where we were on the small cap chart. So if you just if you get rid of UKX and type BARC, there you go. Yeah, and get rid of UKX. Well, yeah, just click draw on that while you're at it.
Okay, here we are.
Now it's a very, very simple call. That's a big fall from like 240 to 140 £1 on 240. So it's about 35-40% drop. Yeah. Now the call is really, really simple. Is it going to go to £1, or is that the bottom? And I think it's a reasonable guess to say that is the bottom. It's made a big fall. It's back down to a bottom where it was when the Russian invasion took place, and banks had been doing a pretty good recovery. They've lost half of the gain that they've had since COVID, so that's pretty dramatic. So is it going to go to £1? You see, the way that I would invest in this and have invested in it, I bought a chunk here, and at £1 I buy another chunk. Simple as that. And is it going to go back to £2? Well, it might take 2 or 3 years. Yeah. But if I averaged at 125 and it went to 180, well, I'd make 50% all day long for that.
Okay. Zach, do you have any views on Barclays?
I hate all the banks, number one. I think they rip us off horribly. I've just paid a £300, what do you call it, overdraft.
I mean, listen, you just raised 2 million with your company, so don't be so negative. You've got plenty of money to spend.
That's actually shareholder money. I don't think it's actually my money, even though I've got 10% of it. It's shareholder money. which I've generously contributed as well. I think the banks are a complete rip-off, and so I do enjoy it when the share price goes through the floor, and they're revealed to be totally incompetent or foolish. But I do agree with Clem. I think that looks like a triple bottom. And if you're going to buy it anywhere, this is the place. This is the zone in the low 140s.
Okay, sounds good. The next question is Twitter. So here we need to kind of
you can get a 9% if you think Musk is going to go through with it. You can get a 9% uplift, and in fact, I might actually just buy a bit of
some Twitter,
a nice chunk. Yeah, it's a 9% discount to its takeout price.
Okay, so let's both up.
I was kicking myself that I didn't, when he said he was going to buy it, I didn't buy it that point.
Yeah, I mean, we were talking,
and it hasn't really gone up since then.
Okay, let's go to
TWTR.
BW.
No, T for Tommy.
Yeah, TW. TR. Here we are. Twitter.
And the takeout price is 55. So there's a $7. Well, that's actually more than 9%. But I was reading it as being 9%.
What's happening here?
Well, that's when it gapped up when he spake, when the great man Zarathustra spaketh.
Okay, fine. So
if you put bars on, actually, it's better because then you get to see. There we go. You get to see the gap. Yeah. And he's 55, I believe, is the price that he's going to take it out at.
Yeah.
So right there's a, well, that's actually more like a it's meant to be 9. I read it. I'm not going to do the massive here.
What was the
9% discount?
What was the 80 spike?
Why? Oh, I don't know. I mean, it's the Nasdaq, isn't it? So it's all insane.
Yeah, it's quite interesting actually. Okay, so are you going to buy?
So it's quite it's quite an interesting thing. If you believe in Mr. Musk and that he's got his money all lined up, because he lost 100 billion when Tesla, when everyone went, oh, he's going to do Twitter now. Oh God, I'm going to sell my Tesla shares. If he's got his money lined up, he's got to pay 55. So there's a 9% uplift. He's at a 9% discount to his offer bid. And anybody that is a Musk fanboy, and I could almost be one of them, can kick 100 grand in there and make 9 grand in 6 or 7 months.
Okay, that's interesting.
It's tempting. I'm very, very tempted, but I'm also, I think that Twitter is a third rail, and touching it is probably not a smart move, but he's done it now.
Yeah,
it's a brilliant move. It's a brilliant move. Whatever he does, he's brilliant at it. And
it's
he'll be
true.
brilliant at this as well.
Don't fight a genius. But on the other hand, it is a filthy bucket of politics that he's dived into, and it's a brave man that wants to touch that particular live wire.
I would have loved to. I would have loved to have bought. I think Twitter it's the thing that I would have bought. I loved it from the start. I think it's just genius, and I think it's a dream come true that somebody who is a genius is actually going to be driving that. So I think it's the best thing that could ever have happened I think that if he can find a way of monetizing it, and I believe he's thinking of doing that via crypto, and rather than take advertising, it will be a transactional platform idea that he might be playing
to basically tip people. So you can already tip people though. For what about how do you see really Twitter to change, including with the crypto integration?
Well, I mean, a simple way of looking at it is Facebook has got 10 times the market cap of Twitter, and Twitter's got a massively dense, smart, engaged audience. And it's a good place to start from if you wanted to generate something that was, equivalent or better or more exciting than a Facebook. Yeah.
Okay. Well, I hope that Musk is listening at this, because, it could be, you might be that you're going to share some ideas for him. But, okay, so it's a good place to start. What would you expect Twitter to dive into?
Well, I mean, I don't really care because I steer clear of Twitter because I don't really want to get attacked by a bucket load of trolls. But the point is, the price is 55, and there you can buy it right now or in a few minutes when the market opens at 48. That interests me. That interests me a lot. 9%. If I believe in Elon, if I want to put my assets on the line, I can earn 9% if the boy comes through. On the other hand, if he doesn't come through, then you're looking at that price coming back down to like 30. Right?
Yeah, the problem is with Elon, the same what he did with Tesla and Bitcoin. I mean, at some point he just came out and say, "Oh, energy problem. Okay, I'm just gonna get out, and Tesla is not gonna accept Bitcoin." I mean, because he would have done those evaluation anyway before. It's impossible that one day just click up that there is an energy problem. For me, it looks like really much a PR move, or like I want to be the man of the moment. I'm doing that, and okay, I think he has got lots of innovation, he can do lots of great stuff, but he'd also like to ride the wave, or I'm going to be the coolest person on the planet. So I mean, and I don't think
he probably wasn't on his own planet.
Yeah, but I don't think even he does it for money. He probably does it to be different, to be the cool, to be the one that everybody's talking about. Maybe
9% says the world agrees with you, because the world says, well, I think it's a fairly big possibility that this deal is going to fall through, because if it isn't going to fall through, there's $7 worth of upside for you to have. Actually, what is the price he's buying it at? Because according to that, it's 48.55 now, but I thought it was $55. But whatever, there's a good amount of upside there if you believe in him. And if you don't believe in him, you're obviously there with a load of other people that don't believe in him. If you go to quote, you should see the pre-market, Steffi. So if you click on quote, and if you scroll down, see there's the pre-market. Oh, you're gonna buy it. You're gonna buy it. Give me that ice cream. Keep going up.
Yeah,
more,
nice food.
More,
What's that?
More. No, there. Stop. Oh, you don't. You keep moving. Go back upwards. Up. Stop. Right. So that's the pre-market.
Pre-market is minus 2.
If you look at the chart, the pre-market says 48.6.
No, that's it.
And he jumped off it again. Never mind.
Yeah, no.
So that is the pre-market. So the pre-market says there's even more even more premium there for you if you believe that he's going to pull it off. Well, he's got them to agree. He's got the money because he's got however many billions he's got. He's worth, what's he worth? 100 billion. So he's putting half his money in with it, or he's going to get other people to come in with him. But market says no. Market says no. He's not going to do it. No. Which is kind of interesting, huh?
Yeah. Okay. That's. I think that was good to cover. Zach, I'm going to leave this last point to you in case you want to bring up anything, any updates, any companies before we wrap it up.
Okay. So shall I start?
Yeah, definitely.
Yeah, no. So, well, as you alluded to, I'm listing on Aquis tomorrow, so that's very exciting. Lift Global Ventures. I won't say more than that. Just I am listing, so it's the culmination of a 35-year journey. So you can imagine how I feel. It's taken a bit longer than it normally takes for ordinary people.
Your feet must be sore.
Yeah, sorry.
Your feet must be sore.
They are very, very sore. They're really, really painful. So that's one thing. The other thing is there's a company called Chill Brands at the moment, and the shares, they've had a placing. It's all controversial. It's all interesting. Shares around 3p. They're placing at 2p. They were trading up to 100p. It's a bit of a Marmite stock, so some people say it's fantastic. It's going to be the next, the sort of wellness.
What do they do?
That's a good question, actually. It's tobacco alternatives. It's sort of the
tobacco alternative. Oh dear.
Yes,
CBD.
exactly. Let's put it that way. So, but you can look up Chilled Brands. I just think there's a new CEO there. He's only 26, which is very interesting because obviously he's 30 years younger than me, which makes me extremely jealous. Well, not that I'd want to be young again either.
I mean, I'm not sure if even 26. I think there are a few people they are able to manage a listed company, but you know, that's
yeah.
my
No, so that's
tobacco
no, but
alternatives.
that's why it's interesting because you've got that's I mean one of the things about small caps is it can be, let's say, entertaining, and this I think has got everything entertaining. It's got new CEOs 26,
exactly.
makes you jealous. It's got this, it's a CBD group which is which had the boom last year and has had the bust this year. So are we going to have the second wave up? Is this the bottom, etc., etc.? So I think it's one of those to get the popcorn out and just keep looking at seeing whether this new guy can turn this thing around.
Oh gosh.
And all that sort of stuff. So that's my the stock to look at, let's say, over the the near term.
So if you scroll down, Steffi, you can see the sales. Scroll down a bit more. Oh, stop. So no sales though. I thought you'd have to be selling quite a lot to be in the weed business.
Well, no, CBD, just a sort of CBD product. So
that's cannabis.
Sorry?
Yes, not weed then.
Yeah, I don't know. I think there was a bit. I mean, it's a bit gone already. This like cannabis wave.
Well, I think it's
your
one
money
of those
goes up in
things
smoke for sure.
Yeah, it's one of those things that, it's just like the crypto thing, and then the other new areas, the NFTs. You have the first wave of massive enthusiasm, then you have a 90% pullback, and then if you're lucky, it'll turn from there, like the .coms did, or crypto has, etc. Or that's the end of it. It's tulips, or it's the South Sea bubble. But I think
don't talk tulips. Tulips was a huge boom in Holland, obviously, but it's still $1 billion industry in Holland.
All right, so that's all right. So it's just the South Sea bubble then that we're left with.
Well, sure.
Well, it's interesting. It's interesting because they've got these many loan notes arranged by and the fundraising arranged by Optiva. So I don't know if you are a UK trader, then you probably recognize the name Optiva. They haven't been doing too bad, so don't know. Maybe something to check.
No, I like those situations, which is this one, I think, where, as I said, you've had the big boom, you've had the 90% retracement or 95% retracement, and then the cellular goods. There's this company. There's a few others where you've had that retracement. Is it now the time? And I think it's a year on from the top of the boom. Is now the time for the rebound. So that's all I'm saying. I think it could be Chilled Brands, it could be there's a cellular goods as well. They had an announcement today.
Could be on its way to a short-term high.
Yeah, I mean exactly. But they are saying
how many jokes can you come up with, Clem, on the subject? This is unbelievable.
I mean, but listen, recognizing the learning from the mistake of the past. That's great that somebody is actually putting in a press release. Usually, not many they do. Anyway, that was interesting.
That's my dish of the day. So we'll see how that goes.
Well,
okay.
If you want any from me, Steffi,
yeah, definitely.
I've got a couple out of what I've been poking over the last few weeks. I think Capita's an interesting one. It's made a very interesting technical bottom.
Capital.
Capita CPI. They used to be a big a darling of the stock market, and then they had a nasty accident and they fell to earth. They became a fallen angel. And if you go and pop in, say, 3 or 4 years on that, EFI will do fine. Look at that chart. I love that chart. That's the sort of chart I love. Now, they kind of fell out of the sky. Then they raised some money, and then they fell out of the sky again. But look at that bottom. I love that bottom.
Gosh, it could go to
no. It's not going to go to 150, Steffi. It might go to something like 50.
Okay.
Yeah, which will be very nice. Thank you. But you look at how dense that consolidation at that bottom is.
Yeah.
So I think they're very, very interesting. They've got a lot of sales. They've got they do lots of stuff for the government. So I think that's a very, very interesting. But this is the sort of company could get taken over. And so I've been playing with that one. And I like ITV because I still think somebody from the US, like a Netflix, will buy them up for small change. I like Anglo American because they had a trip up. They fell on their face a few days ago. So I like it when that happens. So I bought some of that. They pay a fabulous dividend that will blow you away. I think it's 8% or something ludicrous like that. So that's what I've been playing with. That's what I've been accumulating over the last few days.
Okay, so basically we have got Netflix, we have got perhaps Twitter, we have got ITV, we have got Anglo American and Capital, and then Zach Chill Brands, which could be an entertaining stocks to watch. I don't know how many people have got actually the will and the money to just bet on hot, spicy, small cap, but I think we gave some really good idea today.
That's what people want. People, let's get this straight. They don't want to buy Anglo American. They don't want to buy.
They want to buy the spicy one. Yeah, but you need to have a capital because you can't put in just £200. You put 10 grand, you might make some money, but something. But if you put 1,000, you might, if you make 3, you are really, really lucky.
If you start with small sums, I mean, really, the smallest you can go is about 1,000.
Yeah. In
a stock, and you just do that. You build up a portfolio. You're building up your skills, and it might take 5 years. It might take 10 years, but you will end and you're saving into that account. You've got it in a nice, so you're not paying tax on any profits or dividends. In 10 years, that'll be a lot of money there. It'll be so much money, you'll look at it and you'll start to be a bit worried. And if you do it for another 10 years, it'll be a hell of a lot of money. And it will be probably the only capital you have. Yeah. So, it's if you do it long, it's a skill game. And you just keep playing it, you play it regularly, and you use it to save, and you're smart and you're slow and you're diligent. It's the only thing I think anybody in the UK, is that their only chance to become wealthy, only chance of a normal guy to become wealthy is long-term, sensible, diligent investment in good, high-quality stocks. There's no other way that I can see, unless you want to be a football player or win the lottery.
Yeah. So Clem, for the viewers, they follow our program and they decided to go into commodities, gold, silver, and maybe their portfolio is mainly gold and silver, whatever is ETF or is actually blue chips and some small cap. Do you say that is still a fair play, or do you say maybe it's better to diversify in some out of the stock that you are doing, for instance?
We should always diversify unless you are very, very sure of yourself. And unless you've got, a record to back that up. Otherwise, you need to be diversified. Because remember, every time you buy a stock, you're on a learning journey. And, you might make money. You might make a lot of money. You might lose money. But if you follow that stock and you follow the story and you keep your eyes on what's going on, you will actually learn a lot. And over the years, you will become an authority. And you will make great money. If you want to get rich quick, you're going to probably get poor quick instead. Yeah. If you just play the game slowly and carefully with study, it's work. People get paid for work, and the market will pay you. Yeah. And if you use it like a casino, you'll pay it. Simple.
Okay, Clem, I think we cover a lot, and it was great to have you on the show to share all this great insight. I mean, Zach is not here anymore, but good luck with him. And anybody that want to check out Lift Venture, they are going to be listed tomorrow on the stock exchange.
It's quite an achievement to raise money for such an endeavor in the current market situation and to get a listing. It is a long, hard road that he's trodden. Yeah. And he's got it away, as they say, and that's great. Congratulations to Zach.
Yeah, well, Clem, we know that because you did it. And I think ADVFN is having a general meeting on Friday, so tomorrow.
Yes, that's right, yes.
Okay, so let's see.
What doesn't kill you makes you stronger, but it also might make you limp.
Okay, thank you so much, Clem, and thank you everybody for watching. I will see you next